Now, today I'd like to talk about December's role, the month of December's role in the Fed's policy path, right? Now, the upcoming December jobs report will be a critical data point for investors, serving as a closely monitored indicator that could shape the Fed's monetary policy decisions at its meeting on December 18. Now, the report is particularly significant as it will provide insights into the state of the labor market and its implications for the interest rate adjustments. The stock market is entering December with notable strength. We've seen the S&P 500 making all-time highs once again, after a year-to-date gain exceeding 25%. So this impressive performance has been partly driven by investors' optimism regarding the Fed's monetary policy, where the Fed is expected to continue its rate cutting cycle, and that's the reason why what you're seeing that the euphoria is carrying on to the S&P 500, and the price, it's making newer highs. Now in 2024, the Fed has already cut interest rates by a cumulative 75 basis points, fueling expectations that further rate reductions could extend into 2025. And that can be seen from the dot plot. Okay, so first of all, the key insights from the December jobs reports. The jobs data is expected to offer clarity on the underlying labor market trends, which remains a focal point in debates about the Fed's policy direction. Economists are forecasting a robust addition of 202K non-farm payroll jobs for December, marking a sharp recovery from the previous month's gain of just 12K. Now, the weak performance in October was attributed to disruptions caused by hurricanes and labor strikes, which temporarily dampened payroll growth, and that is expected to recover this month, and that's why we have that 200K mark there. So Fed Chair Jerome Powell has previously emphasized that the central bank is not in a hurry. Now, this is a key word right here. It is not in a hurry to lower interest rates, citing a strong labor market and inflation levels that remain above the Fed's 2% target. Now, this will definitely carry weight, because with this understanding, you would then know how to deal with the US dollar and its crosses. If one central bank, i.e. the Fed, decides that, say, I'm not going to cut that much, the rest they're cutting, then you would have the US dollar having the largest interest rates differentials, and that is going to bring a lot of strength in the US dollar. So would Trump enjoy that? Would he want that? Okay, I'll come to that in a short while. Okay. Now, a jobs report showing an increase of 200K or more could reinforce the narrative of labor market resilience. I've talked about it for some time, quite a long time already. The 200K mark is a very strong mark, okay? And every time it crosses above that level, the 200K level, it's just a way of telling the market, say, hey, labor market is strong. You don't need to cut rates that fast. Okay, so if we have this number come Friday, however, if the reports also reveal a rise in unemployment, it might prompt the Fed to reevaluate its current stance. Conversely, persistently low unemployment levels could lead to Fed to reduce the unexpected scope of rate cuts for 2025. Because everything is fine dandy, so why do I need to cut that much? Furthermore, the market is actually predicting that with Trump coming in again and his tariffs, that is going to bring inflation back into the US once again, right? So this is something that you need to, in a way, check once again, properly, and then we'll see. Right, so the potential market reactions to this. First of all, the US stock market reaction to the jobs data will hinge on its implications for future monetary policy. A stronger than expected increase in non-farm payrolls combined with low unemployment could undermine hopes for additional rate cuts, potentially triggering a negative reaction in equity markets. Stocks have thus far been bolstered by expectations that fiscal policies under President-elect Donald Trump, such as tax cuts and deregulations, which the Republicans is known to favor, will spur economic growth despite their inflationary risks. As for the current market sentiments and Fed rate expectations, market expectations for the Fed's next move have shifted in recent weeks. Now, as of now, the CME Fed Watch 2 indicates a 66% probability of a 25 basis point rate cut at the December 18 meeting, which would bring the target range for the federal fund rate to 4.25%, between the 4.25 to 4.5%. Now, this aligns with the Fed September dot plot, which projects a median rate of 4.4% by the end of the year. Now, is this going to continue that way? We will need to see, because in December, we will have another dot plot, right? And that is going to tell us what are the probabilities of the rate adjustments for year 2025, number one. Number two, there's also some changes. Previously, last week, we had a 50-50 chance of a 25 basis point rate cut in the December meeting. Now, this has reverted to the original part where we had a 69%, now 66%, but it's not really that far. So it's like market telling us that, hey, we are going back to the Fed's original projection to have 3 cuts this year, and we will have a 50, 25, 25. So it's back again to that kind of probability. So at the end of the day, right here, the December jobs reports holds the potential to significantly influence the trajectory of both monetary policy and market sentiments. Investors will be closely watching the balance between jobs growth and unemployment, as these metrics will provide critical signals for the Federal Reserve's next steps. A resilient labor market would reduce the likelihood of further rate cuts, while any signs of labor market weakness may increase the probability of additional easing in 2025. Okay, so that's the fundamental report for today.